If you've been watching my videos for a while, you know that option trading is all about one thing: volatility. But then we have to actually ask ourselves, what is volatility? What causes it, and where does it come from? Today, I'm going to break that down for you with a simple model we created called the Three Circles of Volatility. Once you see it, you'll understand how volatility works and how option prices work in a much deeper way. So every single stock experiences volatility, but not all volatility is created equal. To price options correctly and manage your risk properly, you need to understand where different types of volatility can come from. And that's what the three circles are about, because there are exactly three types of volatility that any stock could experience: market volatility, non-event volatility, and event volatility. So the first circle is called market volatility. And this is the very broad type of volatility that impacts all industries, sectors, and tickers. You can think of it as the high tide that raises all ships or lowers all ships. And this is driven by macro factors like interest rates and geopolitical risk, things like that. When big events hit, everything becomes a lot more correlated, a market crash, things like that. And everything starts to move together. And this is why we call market volatility the first circle, because it impacts everything. Now within the first circle, it brings us our second circle. Now our second circle, which you can think of as being within the first circle, is called non-event volatility. Now what this is the day-to-day regular movement that you see for every individual ticker. And the best way to examine this is with an example. Imagine we're comparing Coca-Cola and GameStop. Let's say there's no major events happening for either of these stocks. What would you expect to be the price movement difference between them? Well, Coca-Cola, you'd probably expect less than 1% a day moves and just regular trending up slowly over time, something like that, normal company behavior. But for GameStop, who knows? This thing could be moving 5% a day, 10% a day, randomly with no reason at all. On a regular day-to-day, these tickers move completely different. And so when we're analyzing volatility, we examine the non-event behavior of each of these tickers, which we just call the non-event volatility. It just reflects things like the company's fundamentals and the investor sentiment around the ticker. So understanding non-event volatility helps you set realistic expectations around how much a ticker is going to move on a day-to-day basis, all things held equal. Now, within each of these companies, there's actually a third circle, and this is the one that we call event volatility. And this is the volatility that's caused by specific events. For example, the most common one we all think about is earnings. Earnings drive something like 30 to 70% of how much a stock is going to move in a year. And guess what? That's a lot of volatility. So yes, it gets its own circle. In fact, at Predicting Alpha, we have literally two strategies based entirely around trading earnings volatility. And if you want to check those out, you can get a free trial in the description below. Now, around events, option premiums tend to expand significantly because the potential for volatility also increases significantly. Now, that doesn't mean option prices aren't fair or expensive. It just means that the premiums expand to reflect the market sentiment that there could be a big move in the near future. All right, so now let's tie these three forms of volatility all back to option pricing because, hey, that's what we're here for in the end of the day. Imagine we're looking at, a company like Tesla and it's trading at $100 a share. And let's just say you're looking at a 10-day option. If the market's expecting a normal move over that time for Tesla, let's say it's 10%, then that's exactly what the option prices would reflect for the 10-day option. But what if all of a sudden Tesla came out and announced a surprise earnings event, and all of a sudden, 5 days from now, there's an earnings? What do we expect to happen to the option premium? Well, we would expect that it would inflate significantly because we know that around earnings events, Tesla tends to imply, a 7% move, something like that. And now that option that was once just seeing 10 normal days of volatility now has 9 normal days of volatility and 1 day that is actually an earnings event, meaning that 1 day should see some degree higher of volatility than the other days. And the option prices now need to reflect that. So when you look at an option price, you need to really ask yourself, what am I trading here? What is embedded into the price of the option that I am considering buying or selling? And once you understand this, you can start to be so much more strategic with the way that you trade. If you want to just trade regular day-to-day movements, you're looking to isolate the non-event volatility. But if you think there's a premium around events that you want to be trading, well, maybe now you're trying to isolate earnings events or product releases, things like that. And then if you're concerned about overall market exposure, maybe you're trying to get macro volatility exposure. You're trying to trade things like ETFs, etc. By the way, I think I mentioned it before, but if you're done flying blind and want some systematic strategies that actually work, feel free to click the link in the description below and take a free trial with PA. I have 5 systematic strategies that we made available to the entire community, and you can get them for free. So click the link and I'll see you there. So final recap, there are 3 forms of volatility. We put them into this beautiful fancy model called the 3 circles of volatility. The first one is market volatility, which is just broad moves that affect every ticker. The second one is non-event volatility, which is the regular day-to-day movement of stocks. And the third one is event volatility, which is those earnings events, product releases, things like that, which can cause major movements that are abnormal compared to what you'd normally see day to day for a ticker. It can cause those to happen. And remember, if you don't understand where volatility comes from, it's hard to trade it. So learn this stuff and then start using it to your advantage.